Hi, everybody. Give us just a minute. We're going to let everybody get logged in. So we'll wait about a minute, maybe a minute and a half, and let everybody get logged into the call before we get going. I tried to think of some funny stories to tell during this time, but I couldn't come up with anything appropriate today. So it's just silence. But it does look like everybody that's going to join us is pretty much logged on. So I'm going to turn it over to Charity for some introductions, and we'll just get going, guys.
Okay, great. Thank you, Amy. So for today, we're going to talk about optimizing external opportunities for agencies through growth and expansion. And we have several presenters today that you'll be hearing from. The first is myself, Charity Farnsworth with Healthcare Consult Link. Then we will have Heidi Wall, also with Healthcare Consult Link. Amy Knight with Knight CPA Group is going to be speaking, and then we'll actually round out our presentation today with Richard Chang. Richard was formerly with DLA Piper. You may have heard him speak, in previous sessions. He is now with Weaver Johnston Nelson, and Richard will finish out our presentation today, and then we will wrap actually our entire series today. So we do start our presentation with a brief disclaimer, basically, that you have on your screen. So I'm not going to read it to you. You can actually read that yourself. But then we will move on to look at our series. Now, we are in the last session of our Pandemic Recovery webinar series. We do encourage you, though, if you have not been able to participate in previous sessions, to go back and to look at some of those previous recordings and the slides associated with them. We started July 2nd with navigating the economic incentives. We've gone through emergency preparedness, infection control, doing a quality program, operational efficiencies. Then we moved into financial considerations, even things like emergency paid sick leave, legal aspects of the pandemic recovery. We also added a bonus session mid-series on the PPP loan forgiveness and how to fill out the application for that. And then last week we talked about psychosocial impacts while rebuilding the agency. Then we also, like I said, are going to wrap up today with optimizing external opportunities for growth and expansion. Now, we do have the Pandemic Recovery webinar series website where all of the recordings are posted, as well as the slides from each presentation. So you'll see those there. And the slides for today are posted, as well as the recording will be posted afterwards. Now, today we have several things on the agenda. We'll talk about clinical and clinical operations due diligence. We'll talk about some accounting best practices to prepare for external opportunities. We'll also look at a home care market assessment, and then preparing for mergers and acquisitions as both a buyer or a seller through some of the processes and the information that you might need to know. Now, we are going to have Q&A at the end. We do ask if you would please use the Q&A functionality in Zoom for your questions. If you use the chat, we will see them, but we actually ask that you use the Q&A functionality if at all possible, because that makes it easier for us to save those questions, mark them as answered, and that way we know that we've hit on everyone's questions as we go through. So we're going to start today with clinical and clinical operations due diligence activities. I'm actually going to turn it over to Heidi from the Healthcare Consult Link team, and then I'll be back to talk about more of this in a few minutes. So Heidi, would you like to start?
Yes, so I am Heidi Wall. I'm the Director of Hospice Consulting for Healthcare Consult Link. I want to say good afternoon to everyone, and we're glad that we're here for the last of our series. I hope you've all enjoyed it as much as we have. We're going to be talking about, when we talk about M&A preparation, one of the things, the components of that is the regulatory diligence. So this regulatory diligence may be requested by the buyer or their seller. The buyer often is in the event that if they have a target agency in mind and it's been identified and they are wanting to do due diligence for that. The seller, often in advance of an intent to sell, thinking about selling, they want to identify their potential weak areas. So the purpose of the regulatory due diligence is to provide information that helps determine the valuation of the target company, the risk of the repayments and recoupments that might be associated with some of the non-compliance that's been identified, the risk level of a corporate integrity agreement, if there is one there, if it's actually already in place, or if there is a risk of one, the risk of a key tam or whistleblower lawsuit. Sometimes we see some evidence of that when you dig deeply into the agency itself, the risk of a regulatory enforcement actions that may occur, and then the overall compliance health of the target company. What does that look like? The ability and timeline for integrating the policies and procedures that address the areas that are identified during the due diligence is also look at the magnitude of that and how large is that task and how will that be accomplished, and is it even realistic or reasonable to be accomplished to maintain that culture of compliance. So the goal, again, talking about the goal or purpose of the record, the first thing is the record review. So you want to, before you even start, you want to identify benchmark data to determine how you actually organize that record review. For example, in hospice, you're going to be looking at the principal diagnosing mix, the level of care changes, the live discharge average, and the median length of stay, the average and median length of stay, because what you are looking at is if there is evidence of long length of stay, you may focus more in that area, and you may actually pick more charts in that area. Or if there's a lot of level of care changes, what does that look like? Your sample in that section may be bigger. For home health examples, the establishment of eligibility, including face-to-face requirements. This is something that you would look at closely. The average length of stay, just like hospice. Documentation compliance measures related to the COPs. You'd be looking at those areas and have much focus in that. Other agency type examples include like client hours, compliance with individualized service plan, the ISP, and the coordination of care and supervision compliance. Those are focused areas for record review. So the sample of records, this should be completed by a qualified individual. This is someone who has probably been in home health, hospice, some home care agency operations, who knows that area inside and out and knows what it takes to run a smooth agency. That person knows that the audit tool that they're using in great depth, so they can actually dig into these records and review them. And usually there's a random sample that they choose of active and discharge patients. It's usually a minimum of 20% of the current active census, but it can vary. With larger census entities, you may choose a smaller percentage for that, because you're still going to get a pretty large sample. The comprehensive audit tool itself should be utilized for a consistent record review and tracking of results. So that when we say comprehensive, that means looking at every aspect of the documentation and compliance of that agency. And these results, after you get from using the audit tool, and you have your results and you aggregate those into a report that will identify trends for you, so you can actually be able to put a report together for those trends. And this comprehensive tool allows for the classification of risk areas, as we discussed some of those initially. And additional records may be reviewed if you notice some trends. If you notice some trends, for instance, in a level of care changes, and actually that there's a lot of people maybe going into respite, and you're looking at, what is the rationale for that? Are a lot of the patients, as far as looking at dynamics in the home, are those being addressed by the social worker? There's just some areas that you want to drill down deep into that section once you identify the trend. And then the review of billing documents. So you want to, for the specific records that you review, you want to look at those documents and you want to compare the services that were provided with the services that were billed. Are those billing records accurate? Should those services have been billed? Were they compliant? Was everything in place so that there wasn't a technical area or some area errors or some area of non-compliance for the risk of a payment adjustment? Because when you're auditing and you notice that maybe this is at risk for non-payment, did they perhaps adjust that bill before they actually billed for it? So, you're drilling down again into those billing records. The compliance with specific billing related requirements, pre-claim reviews are an example of this for home health agency. But the due diligence process, once it has been the relationship has been established, it will likely involve a more in-depth review of this billing. So usually the buyer or the seller, they may actually do more financial review to get really in depth of the accounts receivable, billing patterns, and have a nice report from that aspect. Internal audit activities, you want to be looking at these as well of the agency. So you want to determine how frequently are they monitoring and reporting auditing results, with their QAPI program, how often are they doing that? Do they have target and focused audits that they do? And are they identifying those trends? And once those trends are identified, are they putting those corrective actions in place? And what are their performance improvement plans? Do they follow through with these? Do they have noted improvement after they have actually implemented these and identified the trends? And then you want to be also looking at the activities of the agency for external audit activities. The MAX activities, ADRs, TPEs, the surveys, initial and recertification surveys, state license surveys, complaint surveys, the focused infection control surveys that we talked about. What are the results of some of those? And what did they do with that information? Did the agency respond appropriately to that and change their process if needed? The PEPR reports, what are some of the risk areas as far as length of stay and things like that? That'll give you a lot of good information. The STAR and compare reports to determine, are they compliant with their reporting? And then all the related corrective action plans to look at that and see if those have been followed through, as I said before. Now, I believe Charity is going to talk to you about some of the findings that we have in these due diligence regulatory.
Yes. So like Heidi was saying, there's certain areas that we want to look at when we do due diligence because they tend to be areas that indicate that there are process breakdowns. A big part of that is also, as a seller, you have to look at, what are the areas that might concern a potential buyer, and as a potential buyer, you have to look at what are the things that I would have to come in and actually correct from a process standpoint if I did purchase this agency. So it's to your advantage, regardless of whether you're on the buyer side or the seller side, to know what are those things, because you can either fix them now or you can know what you would be getting into if you did have to correct those things later. Some of the things that we find that are common findings that can often negatively impact the diligence include some of the things that you see on your screen. And the first one is missing and/or insufficient documents. Now, this can go many different directions. We know that obviously we're in a very heavy documentation type business. Plans of care are the absolute first on this list. It's very common at HCL, we do due diligence, and it's very common for us to find, for example, that plans of care are missing key pieces, or they're just insufficient for what's being provided as far as the care for the patient. We also find that in general, physician orders either aren't present for services that were provided, or those orders do not cover things properly the way that they should. We know that in home health in particular, we have quite a few issues with getting orders signed in a timely manner. And so it's a matter of, do we have signed orders for all of the things that we are supposed to, not only from a clinical care perspective, but from a billing perspective. No one wants to think that they're going to have to give money back at some point because we didn't actually have a signed physician order to cover it. Some of the other things that may be missing and/or insufficient in the documentation are the election of benefits, consent. You should not even be moving forward without a signed consent, right? So that's very important. Signed acknowledgments of required regulatory information. It's that big packet of information that we have to give a patient or a family member at the time that a patient is brought onto service. And did we have a signed acknowledgement that that information was given to them? Other things include supportive clinical documents for eligibility of services. Establishing eligibility is so important regardless of the service line that you're in, and you need to make sure that you have whatever clinical documents or other documents even that are required in order to show the eligibility requirements have been met. Then the supportive documents for billing. You know, this could be the documentation that supports a hospice higher level of care. It could be the documentation that, especially now that we're under PDGM for home health, supports the appropriate coding. You know, those things are all very important now, and they could come back to bite you in the event of a survey and or potentially a bigger audit process. And those are the types of things that are commonly looked at during due diligence. Then you also want to look at is the documentation there to support the clinical assessments. In home care, the clinical assessment is the eyes of the person who actually saw the patient in the home. That documentation is so important, and it needs to be thorough, and it needs to hit on the key things that are required in order for, you know, the documentation to be considered complete. Now, some of the things that are more technical errors that can negatively impact regulatory diligence include just missing signatures or even missing dates. You know, on the last slide, I talked about the importance of physician orders. Well, you do have to have an order for all of the services provided, but what if that order is not signed properly, or it's signed by the wrong person? Or what if it's signed, but it's not dated? Those are some things that seem relatively minor, but they actually can come back to you in the event that they're considered a technical error if they're missing. Invalid consents or admission documents. Maybe you have it, but maybe it wasn't completed properly. Just as importantly, missing or untimely face-to-face encounters, and this includes insufficient documentation of encounters that did occur. So did you have an encounter, and then do you have the appropriate documentation to support that? And then missing or insufficient hospice physician narratives. This is very important in hospice to make sure that the physician narrative is complete and that it meets core expectations. And if you don't have that, that can be a technical claim error that can come back and again, work against you. Now, some of the recommendations that we have when you're trying to prepare either as a buyer or a seller are to create some checklists for program regulatory requirements. This is that audit tool that Heidi referenced, but make sure that you have some specific checklists, not only to look at the key things within the charts, but are there other parts of your process that you want to audit to be able to say, we have a very tight, efficient process in certain areas for billing or for scheduling or for other things, because keep in mind, when you are on the seller end, you're trying to show that you have your agency operating the way that a buyer would want it to operate in many ways. And as a buyer, you want to know that, you know, I'm buying something that has this in place, or if it doesn't, what it's going to take to get it there. You also want to incorporate your risk areas into your agency audit process. We should always be auditing in home care. And you want to make sure that those known risk areas are incorporated into your process so that you're proactively looking for them. You also want to organize all of your documents prior to the review. You know, one of the things that we find when we do due diligence is, you know, if we have access to all of the documents, it's a far more efficient process, and it avoids the back and forth where you've reviewed what you thought was a complete chart, but then you find that certain components are missing, and there's a lot of exchange of information where it's asking for individual pieces, and it gets very time consuming, and it also means that there are likely to be things that are missed, and they might even be in the record. Uploading all of the documents into the EMR and filing them specifically to the patient or client. This one is very important. We know that there are still agencies that use some version of hard copy charts, either because they only use the EMR for certain parts or they're not using an EMR at all. And anything that's in hard copy, when you're trying to make sure that you have a thorough bit of information on any chart and a complete record review, anything that's hard copy that's not accessible to the people reviewing it is going to appear to be a gap. Now, for internal staff that are doing routine reviews, very, very important. Make sure that you ensure competency and understanding of the regulatory requirements. If you have someone who in good faith is doing what they feel is a thorough audit, but they don't actually know what they don't know, you may think that you have really great reviews coming through in the audits, but then you may not realize that they don't actually know what they're even supposed to be looking for, or they're missing key things that could end up coming back in a negative way. You may want to consider outsourcing your QAPI in advance of a sale to ensure compliance with the regulatory requirements. You know, it's always a decision to look at the pros and cons of either doing certain things in-house or outsourcing them. But I will tell you that, you know, when you're outsourcing, you get an independent set of eyes, you know, someone who doesn't really have a stake in the outcome of the record reviews and the overall QAPI being completed, because they're, you know, they're not auditing their own work. They're not auditing the work of people that they actually work with and maybe friends with. They truly are looking at it from an independent third-party perspective. It's very important as you're looking both, you know, towards a potential purchase and or a potential sale to provide ongoing education if you've identified that those things are needed. And if you're someone buying an agency, obviously you're not going to be providing it to the agency staff until you actually take them over. But what you want to do is look at what type of education has been provided on compliance, regulatory requirements, and is that education documented, and are staff being held accountable for being compliant with what they're being taught? Because as a seller, that shows that you're doing everything you can to try to make sure that your staff are following the expectations. And as a buyer, it shows you, are they getting what they need already, or are you going to have to actually invest more money to get that and then bring them up to speed after the fact? Some additional recommendations to consider are you may want to do a mock survey, you know, from an external source to look at your risk areas. You know, I refer to this sometimes as doing a State of the Union. It's having someone come in and say, if I look at it from a surveyor perspective, what does it look like? You know, and review those results with your staff. Implement corrective action plans. It's no different than having a surveyor come in and say, well, yes, we see some issues, but I also see that you, for one, did self-auditing, you identified the problems, put an action plan in place, and you're monitoring and following through on it. None of us can reverse time as much as we might want to in some areas, but none of us can reverse time. But one thing we can do is figure out how to do things better moving forward and document that we are doing that. If you are trying to be a seller, this can also show that you're taking proactive steps to identify and correct those problem areas so that a buyer doesn't have to. And if you're a buyer and you're looking at it, this would also show that the agency felt that it was worth the investment to have someone come in and do that. Now, it doesn't mean that you will, you know, assume everything is great and that there aren't still some things to look at, because who knows, maybe the person doing the mock survey was the owner's best friend. I mean, I don't know. Excuse me. But that's where what you want to do is have that completed, and that way it gives you a way to show that you're trying to identify where some deficiencies or problem areas might fall. You also want to look at what are some of those most common deficiency areas and monitor those as potentially vulnerable areas. They could impact you on a day-to-day basis, or even if you're not trying to have some sort of an M&A transaction, but they also will be something that will impact you in that specific scenario. Now, in preparation for a purchase, one of the things that you may want to do is identify an external firm to complete record reviews for the due diligence. This is very common. If you haven't been involved in M&A, it's very, very common for a buyer to ask for due diligence, and they do often, you know, pay for the cost of that. They will have a company come in and do due diligence on the agency that they're considering a purchase of. That can factor into the negotiated price, because if they find a lot of issues, they may find, you know what, that means we have to put more money into this after we purchase it, so that will affect our purchase price. However, if you're on the selling end, it could help you identify those weak areas, help you start doing something about them, but at the same time show that you've already identified them, which when you are talking about the potential for financial risk and things like having to invest more money to correct problems, it can also show that, hey, we're trying to get ahead of this, so we have a better position from the negotiation standpoint. So there are pros and cons depending on what side that you're on, but overall, doing good, proper due diligence from a clinical operations or regulatory standpoint can put you in a better position regardless of whether you are trying to sell an agency or you're trying to buy one to expand your operations. It just means that it will help make sure everyone is more informed about the status of the agency that's under consideration. Now, in summary, you know, like I said, both buyers and sellers benefit. Even if you don't end up going through with the transaction, this helps to identify areas for improvement. And it also means that even a seller might look at it and say, you know what, these are some of the things that we want to make sure we're specifically asking about in future opportunities, because it could be a trend between different agencies. And last but not least, any improvement in agency operations should yield a positive outcome for your care that you're providing and meeting the goals, which the overall agency goal is always going to be to provide excellent care with compliant operations. And there is no way that auditing and fixing any problems can actually be a negative in that way. So that's where we're coming from the clinical and clinical operations due diligence standpoint. So what I'm going to do now is ask Amy to post our first polling question. We do want to get some feedback from those of you who are attending. So Amy, if you would launch that. What we're asking is, in the event of this type of due diligence being completed, how comfortable would you be with your agency's compliance on a scale of 1 to 10? So think about that question and just think, hypothetically speaking, with all the things that I've talked about and Heidi's talked about, if you or someone else did due diligence on your agency, where on a scale of 1 to 10, with 10 being the best, where do you think your agency would actually score? So we'll give you a minute to put your answers in, and then we'll see what everybody's results came out to.
Charity, you had someone ask if 1 is great or 1 is poor.
1 is poor and 10 is great. So we want to be a 10 out of 10 on the scale. We want to be a perfect 10. Let me put it that way.
Don't we all?
I'm telling you, in more ways than one.
People are still voting. Let me give it a few more seconds.
Okay.
All right, I'm going to close it down and let me share them for you.
Okay, so the good news is that it looks like that most of the agencies are in that 8 range or 9 range. The lowest that anyone in the group mentioned was a 5, so I think that's positive that agencies feel like they are at least mid-level as far as their compliance in the event of a due diligence process. And I think that, you know, being in that 8 to 9 range means that we have some good confidence level there, so that's really great. Okay, so what we're going to do next, I'm going to pass it over to Amy, and Amy can talk about the accounting best practices.
All right. I'm just going to kind of piggyback off of what Charity was saying all along, in that I like the last point is that she said, you know, even if the transaction doesn't happen, or what I also like to say, even if you're not looking to do a transaction, these are ideal little audits to put yourself through to really refine your agency and up your game, right? And so kind of my point is that, you know, you want to be really following best practices, right? There's the compliance and operational part, which, you know, covers clinical. There's also the financial piece, which I'll cover, and then you get to the legal pieces. So for me on the financial part, but I think this holds true also for the compliance, clinical, chart review, billing pieces. Don't wait until it's like, I want to go now, right? Because what you're going to find is buyers, or if you're buying or selling, the other party is going to want to look back for a few years. And I guess that really goes more if you're looking to sell. But if you're looking to sell, don't wait until you think you're ready to sell to start getting ready. You need to be ready all along. And that's why I say, even if you're not considering an acquisition, why not implement these best practices? Because when the day comes, you're already going to be ready. And I kind of compare it to, you know, maybe like getting a house ready for sale. Why live in a house where it's outdated? And I wish I'd read this article, but I just saw the headline that there's actually a term for it where you just, you know, you let everything go, and then it's time to sell, and you update everything. Well, you could have lived in it updated, right? So you don't want to wait till it's time to sell to fix the roof, fix the gutters, fix the irrigation, whatever you got going on, and fix everything all at once. A, it's expensive. B, it takes time and coordination. But that's the same thing with any kind of due diligence, looking at any kind of acquisition. And so on the financial side, they always go back 2 or 3 years. Unless, and what I guess also kind of what happens is you get caught in I think, in a situation where maybe you're not at your best right now, like you guys just voted, but you could get there if you had a little time. So these are those tools to start listening to implementing, take under consideration, implement, and work through to get yourself up there to that level. And when you're looking at purchasing or selling, don't quote me on a range, but for a long time, the going range for a Medicare home care agency was a multiple of 4 to 5. Well, that can be a big swing, right? Let's say you're $1 million agency, pulling numbers out of the air. Well, that's a $4 million sell versus a $5 million sell. I'm talking about EBITDA. That's not even what my discussion is, but it's a big swing. And so these are the things that are going to get you closer to the higher end, whether you're selling or if you're a buyer, you're going to be expected to pay higher. If they can tick all these boxes and their stuff is all organized and put together and it's clean, that should command a higher price, whether you're buying or selling. And so those are things that, I always try to put in people's mind. Don't wait until it's time to do it. Do those things now, so when it's time, you're already ready. Another thing, and I didn't put it in my slides are a little light, and I'm sorry, I was just going to wing it. I told him I can BS my way through 15 minutes anytime, but it's all relevant material. But I totally lost my train of thought. It'll come back to me. Will you advance to the next slide, please? So for the accounting side, well-established accounting policies are very important, and a lot of agencies don't have any at all. On accounting side. The fact is surveyors come in and review your clinical charts, they review your operations, they make sure you have a policy and procedure manual. But nobody comes in and reviews your back office, your accounting side. Nobody looks at your bookkeeping. Nobody makes sure that you get that done. The only way that we know it's done is you filed your cost report and hopefully you filed your tax return. Everybody files their cost report because if you're Medicare, if you don't, your money gets shut off. You can still get away with not filing your tax return until the IRS tells you need to get it filed, but there's no immediate penalty from not doing that. So, get some well-defined accounting policies in place. You should be, at a very minimum, your accounting should be updated monthly. This is a bare minimum. It really should be updated regularly, like throughout the week, right? How do you pay your bills? What's your cash balance? Those kinds of things. You need to reconcile your bank accounts. And I know a lot of this sounds like 101, and it is, and especially if you're an agency that's looking at expanding, but I work with a lot of agencies that this is not their standard. They want to get there, but they're not having these things done on a regular basis. So that's why I do want to cover them. Reconcile your bank accounts, reconcile your credit card accounts. Those should be in your general ledger, QuickBooks, what have you, and you should be tracking exact expenses. So for instance, on a credit card, run a register. Don't just say, here's my Amex bill, and part of it was office supplies and part was travel and part was marketing supplies. You need to have every single transaction recorded properly and then reconcile that account just like you would a bank account. You also want to segregate your duties. This is I don't want to say a red flag, but it's something that anybody completing due diligence would look at closely. If you've got one person that receives your paper checks that come for deposit, they make the bank deposit, they pay the bills, unless it's the owner, that's different, pay the bills, cut the checks out of QuickBooks or wherever, and run the payroll, you have a huge risk for embezzlement in that scenario right there. It does happen more than you would realize. So you want to segregate those duties. And especially that if that same person then reconciles the bank account, they can completely cover their tracks on what they're doing because nobody else is looking at anything. So you want to segregate these duties a little bit, right? And I'm not saying you need a five-piece accounting staff, but you do want to try to segregate. Whoever signs the checks does not do the bank rec. Whoever runs the pay, you don't have one person doing it all. And I know a lot of small agencies do, but you really need to try to segregate that. Ensure your financial statements are set up properly for the industry. So when you're wanting to look at a target's financial statements, if they give you financials and just as salary expense, that doesn't tell you anything. You need to know how much is direct care, how much is administrative, how much is marketing, how much is RNs versus LVNs, right? You want to be able to dial those things down. That needs to be done on a regular, ongoing basis. That's just part of your standard accounting policy, not something that, oh, I need to get somebody to clean this up because somebody's going to look at my books, right? Outside accounting firm, of course, is probably your best bet at doing any of these. Bookkeeping firm, accounting firm, CPA firm, any of those will do. But they can do that. You can segregate your bank rec by hiring an outside firm to do that bank rec. So maybe your staff does the accounting, but they do the bank rec. That is a great segregation of duties. Then also they should help you get your financial statements in the right order. So like our firm, we use a very standard chart of accounts that does it. It dials all of that in. It makes it super easy for us to calculate your cost per visit directly from the financial statements with a visit report, right? Like I don't have to go add a bunch of numbers and divide by this. I don't have to do a whole lot of math to get to those statistics. Is your back office using current technology, right? Because if you're, again, on that scale of 4 to 5 multiple, or maybe you're, there's going to be a scale of a purchase price, right? There's always going to be a high end, low end. If you're looking at that, if a target does not have a good infrastructure, then that's going to limit what you're able to do with them, right? So maybe they're local and you just want to add them to your existing infrastructure. Okay, cool. Then you don't need somebody with a sophisticated infrastructure. But if you're trying to maybe go to another area or get into another market, let's say maybe you're a home care and you want to go into hospice. There's a lot of that going on. Well, maybe you need your target needs to be a target that already has an infrastructure, right? It's kind of like on the billing side. Do you want to go acquire somebody that's been billing manually? Probably not. There's software for that. So look at back office, same thing. Are you using current technologies? Are you cloud-based? Do you make it efficient? You're efficient and therefore your administrative costs are lower. Those are things. And then also, can you scale that? If you're using the right tools, it's then scalable, right? And so it all depends on what the scenario is, but these are things that are going to get you higher on that spectrum of purchase price or sell price. Again, kind of a no-brainer, but are all of your cost reports and your tax filings up to date and current? Keep those things current. Not only current, but don't file your tax return on extension due date. That's a bad practice, period. I can tell you how tired a tax preparer is come September 15th and October 15th. That is not when you want your tax return being prepared. Let me just say that. I don't do taxes. Same thing with cost reports. Come May 31st, I'm exhausted. So, get those done early, get them in, get them early, keep your compliance in line. Outsource your payroll. I'm looking at this, and this is becoming a bigger and bigger deal. What I can say is under the PPP rules, we're going through the forgiveness process now with clients and other people. If your payroll is outsourced, the required documentation is far less than if you do it yourself. And that's because the government realizes if ADP is doing your payroll, they're they're doing what needs to be done. Your quarterlies are filed, the reporting's all there. All you got to do is get the reports out of ADP and give it to the bank. If you're doing your payroll yourself, they're scrutinizing that a lot tougher. So that's one interesting side note just in the environment we're in right now. But without COVID or a pandemic, outsourcing your payroll, again, it does cost money, but it frees up so many resources. You cannot hire staff unless you've got, 2,500 employees. That's kind of a different scale. But, even up to 250, 300, 400 employees, it is so worth it to outsource your payroll to the right group and get all of that burden off of your desk, because it's so tedious and time consuming. And so when you're looking to acquire or sell, if you're looking at buying a company that has their payroll outsourced, especially if it's outsourced to a reputable company, it's a lot easier to verify, because you want to go in and make sure, have they paid all their taxes? That's a big, big deal, right? It's much easier to go in and verify that if the payroll is outsourced. The truth of the matter is, if payroll is on QuickBooks, I can fabricate whatever I want. I mean, anybody smart enough to run the software, they can go run 15 payrolls. They can go delete 15 payrolls. They can make it look like their administrative costs are really low when really they're higher, right? And I'm not trying to be evil and crooked, but these are the things you want to look out for. So I am a big promoter of outsourcing your payroll. I don't do payroll, so it's not a sales pitch either. What's next? This one is very interesting. Ensure that all of your company, any ownership or management changes, were properly reported to the licensure boards, like, the state of Texas, the state you're in, Medicare, Medicaid, the government, whatever, wherever that's supposed to be reported, make sure that's done. And that includes a change of management, okay? So the scenario here is, and I cannot remember the exact clients, I can't remember the exact details, but I recall there was an acquisition, and they forgot to report some fairly minor change in ownerships. So there wasn't a major change, but they were like a partnership, and maybe 10% ownership had changed, or 5%. So it wasn't major, but it happened years ago. And there were 2 changes that had not been reflected. And so then when Richard comes in to do legal due diligence, it was a mess, and there was a lot of work that had to be done. I kind of think about it, I always go back to real estate. I don't know why, I'm not a big real estate investor, but think about your title insurance. You got to pay for a title policy, and the lawyers come in and they're basically verifying that what you're buying is truly owned by the person selling it. And then when the title transfers, that you truly own it and there's nobody else interested along the way. It's kind of like we almost need that in this world, because some of those changes never happened. And so when they were ready to full on sell the whole thing, it was a really big mess to unwind. And it wasn't just once. I've seen this happen multiple times. Just that time it was a big mess. And I was like, okay, that's now worthy of being mentioned in these type of presentations. Some other things that buyers look at when they're coming in looking for a target acquisition, and again, looking at that scale of price, is your referral sources. Are your referrals all coming from one place? If so, that's not so good, because think about a small agency, sales, you buy it, and the owner goes away. Well, did the referral source just go away? Then what did you buy? I mean, I know you're not buying a referral source, but you kind of need those referral sources, right? And you rely on them. So if you're looking to sell, make sure you're diversifying your referral source. Try to get as many sources as you can. And if you're a buyer beware if there's only 1 or 2 really concentrated referral sources. And then, go a step further. Is that referral source tied to the agency, tied to the brand? Is it tied to the owner? Is it tied to a marketer? These are things you want to evaluate and look at. And then lastly, I think this is the last of my slides, is that, again, this kind of goes without saying, but it doesn't. It is really, really hard to get other people to run your business the same way you will run your business. I know this firsthand, and I have an amazing team, but nobody owns it like you own it. So you cannot sit in the background and say, okay, I got these people run this and these people run that, and you're just checked out. If you're checked out, it's going to show. It's going to show in the quality of processes in your agency, the quality of systems. Maybe the systems are there, but are they being used properly? I've seen this over and over and over again, to where, I mean, I've seen some deals really go south because of, like, my client was the seller, but they were super checked out. They thought everything was hunky dory. They didn't know what was going on behind the scenes. They knew they had cash in the bank, and it was an agency that was doing well, but I can go on about stories of, going in for billing due diligence and opening drawers and finding ADRs, stacks of ADRs that just haven't caught up yet, that never got addressed. And so as an owner, you've got to stay involved. Doesn't mean you got to do the day-to-day details, but you got to be in there and you got to be involved if you want to really excel your agency to the next level and be ready to acquire somebody else or sell your agency to somebody. So those are my 2 cents. I didn't do a polling question. I'm going to hand it off to Richard, and he'll take you through all the legalities of everything. Richard, you're on mute. He's a rookie. I knew I'd have to tell him that.
I always forget. Thank you for that smooth transition. Hi, everybody. Good afternoon. This is the last leg of the presentation. And as Charity told you at the beginning of the presentation, you probably noticed a change in the law firm name from DLA Piper to Weaver Johnson Nelson. So in short, I went from a large global firm with offices all over the world to a local boutique healthcare firm that focuses on entirely healthcare matters. And of course, my practice has not changed, so I continue to serve primarily in the post-acute care space, which includes hospices and home healthcare agencies. So really my presentation is looking at the home healthcare market, what it looks like right now. A lot of the stuff that Amy talked about, I made notes of that I'll either elaborate on or provide some additional clarification from a legal perspective. But a lot of the work that I do in the M&A space very much involves professionals like CPAs, bankers, and insurance agencies, and whatnot. So we'll look at the overall healthcare market and what it looks like, especially for those of you who are perhaps in a position to either buy or sell, but you're a little reticent about what the market's like because of COVID-19. And of course, the climate has changed overall for the economy, but let's talk about how it's really directly impacted the home healthcare agency. And we'll transition into change of ownerships and how to structure a change of ownership and providing you a roadmap of what a sale actually looks like, both from the buyer side and from the seller side. This is a very large percentage of my practice. I spend a lot of my time in the corporate M&A world, particularly when we're assessing regulatory issues in conjunction with that transaction. So this is a very significant part of my practice, and but let's take a look. Let's take a look at what the economy looks like right now and how it's impacted agencies and you as operators. In short, it hasn't really impacted it that much as dramatically. It's impacted it some, but it hasn't been as dramatic as most people think it is. In fact, in 2019, the anticipation for 2020, the market for investors and cash flow going into the home healthcare agency was going to be significantly better in 2020 than 2019. Of course, that was pre-COVID and pre-anticipation of COVID. But as it stands right now, home healthcare news, they spoke with several economists and also the BRAF Group, which is a mergers and acquisition advisory firm. They said really the market hasn't really shifted all that much, and it's business as usual. And they're still looking at due diligence and all the normal stuff they've been looking at on how to close a deal. People are still looking at targets, private equity groups, private investors, single investors, strategic partners. When I say strategic partners, it's usually somebody within the industry already, and they're assessing the healthcare market. How can we properly align our current operations with other players in the industry? They're still looking at targets. They're still assessing financials, and to see the best way of growing this particular industry, and also how to see if there's any good collaboration with existing markets. For deal making to remain stable, so banks and financial entities, they have to stay engaged. In fact, the evidence has shown that banks are actively reaching out to people to position themselves in a situation that when things do pick up, as they are anticipated to do, they're first in line, or they're at least top of mind, right? And so people are still remaining active. Now, if COVID-19 continues, the anticipation and the economists have predicted that it will provide more of a long-term threat to the industry. So, we're obviously only about 5 months into COVID-19, and we don't know how long it's gonna last, or to what degree. And to what degree is a big question, and it's gonna have a very, very strong impact on this industry. Elective surgeries obviously went away for a period of time, and now they've come back. That has an impact on home health. So a lot of different moving parts, a lot of different factors that could really change the industry. But as of right now, it hasn't really changed all that much. Next. So before I really get into it, I think it's important, and I was talking to Charity about this not too long ago. I've been in and out of the home healthcare industry for almost over 20 years now. Why? Because I got into this industry in 1999 from a clinical side, and it wasn't really until 2003 that I went to law school. So I had a prior career, and one thing I've noticed is, and even in the last, I would say, 15 years of representing healthcare providers, and of course, home healthcare agency operators are no exception, is that you have a very wide variety of different types of players in this industry. You have some that are very sophisticated, and they have a huge team. They have a big support group. They can tap into different resources. And then you have, and of course, on the other spectrum is you have the mom and pop shops that maybe you're just getting off the ground, and you don't have those type of resources. And at the end of the day, you don't know what you don't know. And sometimes it's confusing to understand, why buyers are asking for this, or why it's important to disclose that, or why prices are the way they are. I noticed that Amy mentioned the word EBITDA earlier. That's a very big word in my world. And I've worked with clients that, quite frankly, don't even know what that is. And I'm sure there's plenty of you who are on this call in this presentation who still don't know what that is. Without getting into a financial breakdown of 101 class of that, I just want to give you an idea of what the global market is right now. In 2019, it was estimated that the global home healthcare market size was $281 billion, and it's expected to have a compounding annual growth rate about 8% for the next 7 years or so. And obviously that's impacted jobs, or that's going to impact jobs, according to Bureau of Labor Statistics. Next. This is a chart from 2016 as it projects out to 2027. So if you look at the fifth bar from the left, we're at 2020. That's where we're at. So we're quite a bit higher than what it was at 2017 as far as the home healthcare, the U.S. home healthcare market size in terms of billions. and it's projected to keep going up. And it breaks it down between services and equipment. Next. And of course, skilled services is a significant part of that. I'm sure there's plenty of you who are on this call that operates both in the home healthcare space and providing the skilled service and the PAS side as well. It's not to say that PAS is insignificant, but in comparison to the overall dollars that it generates, it's substantially smaller, but both equally important. Next. Okay, so people ask, well, what is market? You know, it's a very loose term. I mean, market is composed of a lot of different factors. You know, you're looking at how the projections of how well the industry is going to do, what I just showed you in the previous two slides. You're looking at buying power. You're looking at what the projected rate of return is on an investment. You're looking at a lot of different factors on what is market, and you're really talking about dollars and cents, and you know what people are willing to spend versus what what they're looking to get out of it. But you've probably heard of the term market cap, and market cap is just simply how much a share is worth in any given company. So you really take the market cap of a company is you take the total number of shares or outstanding shares technically, and you multiply it by the price of an appraised price of one unit. So if you have 100 units in a company, let's just say if you own a company that's called ABC Home Healthcare LLC, and you're generating revenue, and you have all these moving parts in your agency, and you have a census of X, and you go out and get a professional appraiser, and they appraise your company to be worth X. Well, you divide that by 100, and you get a per unit price of that stock. So that's really how much your company is worth on the market. Okay, and then you have what's called buyer power ratio, and without getting into too much nitty gritty, it's really the size of the buyer or the buyer market cap. The reason why I'm telling you what the market cap is because the buyer has a market cap too. And you compare that with the size of the transaction. So in other words, if the buyer market cap is really high and the purchase price or the size of the transaction is very low, typically you have a big buyer power ratio, which gives typically the buyer significant more leverage in any negotiation or any M&A deal. However, if that ratio number goes down, it shifts a little bit more leverage to the seller. There are other factors in determining what leverage can be, but that's one big determining factor. So a perfect example is if you're a small agency with about 30 to 40 patients on census, and Encompass is coming in to buy you. Typically, that buyer power ratio is going to be shifted on a much higher scale in favor of Encompass. However, if you're looking at a small agency buying out another agency, that buyer power ratio is not going to be as dramatic, or the ratio isn't going to be as big of a difference. So you have more of an equal playing ground. Why? Is because they have more resources and they have more leverage to negotiate prices, conditions, so forth. And what that really does is it impacts the behaviors of the buyer and the seller in any given deal. What I find as an attorney is that typically, if the buyer power ratio is higher, the sellers are going to be more careful on what they disclose in their disclosure documents are. And if the buyer power ratio is slower, many times they're not as careful, or maybe they don't want to disclose everything, or maybe they have a tendency to not disclose as much because they don't feel the pressure of having to do that. That's just something that I've noticed while doing these deals, is that it really impacts the behavior of the seller and the buyer, and the dynamics that go on is pretty interesting. Next. I guess we have a polling question. Amy, you're on mute.
I'm sorry, I'm coming. There you go.
Okay, so with the current environment of home healthcare agencies, has your ownership considered any of the following? I'm going to give you about a minute or maybe 30 seconds to look through that and put down your answers and submit it, and then we'll see what the results are. Okay, has everybody done voting?
No, they're still flowing in.
Got it. Okay, not a problem.
All right, let's give it about 10 more seconds.
No problem.
All right, I'm going to go ahead and end it, and let me share it for you.
Aha. So 54% said none of the above.
Sorry, I had to add that one to the polling question because it needed to be there.
Okay, what was the right answer, Amy?
Well, that means nobody's looking to expand. I mean, because the options were you were going to purchase another agency for expansion, you were going to expand through new branches, you were going to sell one of your locations, or A and B, or all of the above. So I added none of the above.
So that's interesting. So nobody is looking to purchase another agency for expansion purposes.
I think people are too, what I'm picking up is too uncertain, too much uncertainty still.
Yeah, and I think that's a fair statement. It certainly goes against what the numbers show with some of the other statistical samplings. But I mean, I can understand that, of course, different samplings have different results because talking to different people. But that's interesting to see that no one's looking to expand to buy another agency. Okay, next. Okay, so let's really talk about the map of a transaction. I think this, for those of you who are on this call, if you don't pay attention to anything else, pay attention to this particular slide. I think it gives you a really good idea. It doesn't go into every aspect of it, but it does give you a roadmap. One thing I've encountered is I've represented a lot of investors who are quite frankly ignorant of this industry. And they may not even be very well equipped as far as just buying a company. In conjunction, I've represented operators and owners of home healthcare agencies. And the thought is that you just go in there, you find a buyer, and you buy it, and you sign the purchase agreement, and that's it. It's a lot more than that. And if you don't do everything you're supposed to do, you know, some major adverse effects could happen. Now, I'll go ahead and tell you a story about that after we get through this roadmap, and I'll explain why. But typically, you know, with any transaction, it's a buyer who either hires a business broker or just knows the current operator, and they start having preliminary discussions about the ideas of perhaps buying that agency. Basically, the buyer expresses some interest, and they have very general discussions on deal points, and typically it's, well, how much is your, you know, what is your census, you know, we have this, and, you know, what is your overall revenue? They're looking at referral sources, as Amy said, a lot of very general discussions. And then they have a discussion about, well, you know, how much are you seeking to sell your agency for? They're not really confirming anything, but they just want to get a general idea. Then, you know, many people go into preliminary due diligence, and they just want to see what your financials are like. It's a lot of looking at your financials and talking about the operations of the company. And then if they're truly interested, they'll go into a letter of intent. And a letter of intent usually is a letter that's an agreement, and that's really providing you the roadmap or a guide on how to conduct the overall transaction, because that letter of intent will outline what type of a purchase it is, whether it's a stock purchase or an asset purchase. It's going to identify the purchase price. If there's seller finance, it's going to identify that. It's going to certainly identify the due diligence period, whether it's 30 days, if it's a very small deal, or it could be 60, 90, 120 days, whatever the two parties agree to. You typically, the seller is locked into an exclusivity or a buyer exclusivity, so it prevents the buyer from going out buyer shopping during the due diligence during the due diligence period. You know, as a buyer, what you don't want is you don't want to sign a letter of intent or have spent a bunch of resources doing your due diligence and spend manpower, and then halfway through the seller goes and finds another buyer and says, "Oh, somebody offered me $10,000 more," and it's a waste of everyone's time. So that's something to be considered. It certainly doesn't lock you into the purchase. Because because you still have to sign the purchase agreement, but the letter of intent is just simply showing an intent to buy. It's a prospective sale. Typically, the buyer is locked into an NDA. The non-disclosure agreement is a document that prevents the buyer from acquiring proprietary information or information that's sensitive to the seller, and then later on disclosing it or out into the market or using it for his or her benefits. So the non-disclosure agreement really protects the seller from having their financials and their internal information being disclosed. So number 5 is really the bulk of the work in any transaction. I'll give you a perfect example. Right now, I am in a big sale, and this sale uses a VDR, a visual like a video, an automated or electronic room that people upload documents in. The VDR is really it's a tool to use due diligence. So instead of shifting and passing documents back and forth or sending it through email, you just upload it. Think of it as a fancier Dropbox. But during the due diligence period, the buyer issues typically what's called a due diligence checklist. It'll ask for very specific disclosures of what they want to see, which it would typically include clinical information, financial information, legal, insurance, employment, tax, corporate structure, any intellectual property. And of course, if you're buying, if you're conducting the sale through a stock purchase, you're acquiring all that as a whole. However, if you're doing an asset purchase, you can essentially pick and choose of what you are or are not buying. Typically, even if you are doing asset purchase, the state license and the payer sources are going to be part of that asset purchase. And but if you're doing a stock purchase, it'll include everything. So the due diligence is really a chance for the buyer to review and dig deep into the company. I think this is the part that a lot of home healthcare operators fail to understand how important this is, because there's some serious liabilities later on down the road after you sold the agency if you don't properly disclose, from the seller side that is, the requested due diligence. As an example, if a prospective buyer is asking for, let's just say, insurance claims that's been filed in the last 3 years, and you only disclose 60% of the insurance claims or 80%, and there's something that you're not disclosing. Maybe it's a new insurance claim that's related to a labor employment lawsuit, and you have E&O coverage, and you didn't disclose that, and then after the purchase, the buyer later on finds out, and you didn't disclose that. That's something that's specifically asked for. That's probably going to lead to a post-closing dispute, which could very well end up in court, if not at least some form of a settlement where requiring the seller to make the buyer whole because of the failure to disclose. Of course, there's the purchase agreement. You have to decide early on, and it's usually identified in the letter of intent, which is item number 3, on whether or not it's going to be a stock purchase or an asset purchase. And it's important for you to know the difference and the regulatory and legal impacts of each. We have a lot of information to cover, but I can go down the list of, identifying all the pros and cons of a stock versus asset purchase, but simply don't have the time for that. But the difference, and obviously, obviously you can talk to one of us after this presentation, or hire one of us to tell you thereafter, whatever you want to do. Of course, part of the due diligence and in conjunction with the purchase agreement are disclosures. Usually the seller is going to turn over what's called a disclosure schedule. In that example of an employment litigation matter, that's something that you should disclose. And the disclosure document should line up with the purchase agreement. So if in the purchase agreement it talks about employees under Section 5, then in the disclosure schedule, it should identify which duty you're actually meeting within the purchase agreement that fully discloses your vulnerabilities. And keep in mind, disclosures, why people don't want to disclose certain things is because they're afraid of the purchase price going down. Because the more you disclose, and especially your vulnerabilities, the buyer can always back out, or they can negotiate to have the price reduced because of those potential liabilities. And as it relates to what Amy was saying earlier, she has seen multiples of 4 to 5. And if you have $1 million, if it's a 5-turn EBITDA, then you're looking at a $4 million purchase. I've in recent years, in tough years, I've seen it as low as 2 to 3. So if it's $1 million business, and if it goes from a 4 to a 3 or 4 to a 2, you're looking at a 50% reduction. How to build up that EBITDA value, how to build up the overall value of the company, is obviously cash flow and a lot of other factors. For example, if you build in a compliance program, if you build in certain processes that can mitigate damages or that can mitigate liability, or maybe you're doing something to comply with a corporate integrity agreement, and for compliance purposes, you have a hotline. That's all something of value that the prospective buyer coming in doesn't have to implement. So that will protect the purchase price a little bit better. Having a clean license with minimal deficiencies, having minimum investigations or audits by Medicare or other payer sources is huge. I did a big sale a couple years ago, and halfway through we found all these ADRs and ZPIC audits, and that really kind of killed the price for the seller. Then again, conversely, if you don't disclose that in post closing, you could very well have a lawsuit on your hands as well. Negotiating points, we just talked about that, but within the purchase agreement, you're going to want to negotiate in the indemnification provision and how broad or how narrow that is. Reps and warranties is very big for sellers, because if in the purchase agreement the reps and warranties provision is written that's overly broad, and that you're representing certain things that you didn't intend to represent, then you could be on the hook after you close the deal. Essentially, what the reps and warranties is, it's the one main provision for on behalf of the seller that you have to really be aware of, because the reps and warranties is basically you saying as a seller, I'm guaranteeing you, buyer, that my agency is in this condition. There's probably a provision in there that also prevents the seller from making any major changes or doing anything that damages the value of the company. There's going to be a provision to that. You're going to want to think about an escrow holdback account. For buyers, they typically want to, they may negotiate maybe like a 10% holdback amount to put into escrow, and then after a certain amount of time, the seller gets that money. If there aren't any liabilities that appear during that escrow period. So the perfect example I can give you is, if the purchase is $1 million, the buyer could very well say, well, we want to put $100,000 of that or $200,000 of that in escrow for 18 months. And if it goes into a holdback account or an escrow account, the terms of the deal is that in that 18 or 24-month period if if we have to pay back any money because of ADRs, or if there are any settlements because there's a pending lawsuit. It comes out of that holdback account so that the buyer isn't left with isn't left with that liability, and that that money is taken out of the overall purchase price. So as the buyer, I usually try to get my buyer clients to look at a potential pullback amount if we find something highly sensitive during the due diligence period. Concurrent filings, of course, there's Medicare CHOW, and of course there's a state licensing CHOW if it's deemed appropriate, and we'll talk about what the CHOWs look like after this. And of course, there's the closing and the funding and post-closing issues, reconciliations. If the money went into the appropriate accounts before the tie-in statute is announced. So the buyer and seller usually have to true up any amounts that went into the wrong accounts because of payments. And of course, there's litigation. I was involved in a really large litigation matter representing the buyer. Actually, we sued the seller, and we won a $6 million judgment because the seller breached the reps and warranties, and that's going back to item number 8, and that there were some fundamental issues that were specifically defined under the reps and warranties, and they weren't entirely honest about their disclosures. We sued, we got judgment for $6 million on that. So as the seller, it is important to do these transactions effectively and appropriately. Next. Okay, for change of ownerships, many of you on the phone are very in tune with what this is. I can only suspect that there are people on this phone, on this call, or on this presentation that's listening in that just got into the industry. But a change of ownership is part of the transaction. It's when the proposed new operator is attempting to secure the license or Medicare certification in order to operate the agency itself. Typically on the part of the state license. So I always call it double layer CHOW, right? Because there's really 2 change of ownerships if you're doing an asset purchase. You're not only are you filing the paperwork for the change of ownership for the state license, but you're also filing the paperwork for the Medicare certification as well. And before the change of ownership in the state of Texas is when you have a change of 50% or more in the ownership of the business. So you're looking at also 2 layers up of any type of changes in the ownership of the agency, or it's a change in tax identification number. But now it's just a change in the federal tax ID number effective October 6, 2017. Next. So what is not a change of ownership, or what's not a CHOW? It's when you change your information. A perfect example is when a buyer comes in, acquires the agency, but there isn't a change in the tax ID number, but you're changing locations, or if you're changing the phone number, and you're changing the name of the agency. Those are all changes of information that has to be filed within a requisite time period. And the penalties, I don't remember what the penalty amounts are, but they're usually not very big. But if you look at the website, the change of information deadlines vary from item to item. So some of them are 15 days, some of them are 30. So an expired license CHOW is not allowed. Next. I think we just talked about this. I don't have to get into it. Yeah, there you go. It's a $100 late fee. It's nothing huge, but there is a penalty for failure to change the information within a timely period. Next. Okay, so with a transaction structure, you can typically do it in a couple of different ways. You can do a stock purchase or an asset purchase. Very rarely is there a merger. I've been part of a couple of mergers, but they don't happen at at the smaller agency levels. It's not to say that they can't, but typically they don't. So with a stock purchase, it's really when a party, where it can be a party or it can be an entity, they're essentially buying the stock or the shares of a company, and think of it as removing the current owner out of the company and taking a new owner and stepping in the shoes of the former owner. Nothing changes. The company stays as is. If it was called ABC Home Health LLC before, it still remains ABC Home Health LLC. So what does that really do? That, it has a couple of advantages. First of all, the stock purchase agreement is a lot easier to draft on me, which means that your lawyer spends less time drafting it. Two, you don't have to change. If you're in a building you're under a lease, or if you're under certain vendor agreements, you don't have to change anything because the entity and the contracting parties didn't change. Another major advantage, in my opinion, is that you don't have to file for a Medicare or state licensing CHOW. There's no CHOW. You just file for the change of information. Everything's very streamlined. Now, the content within the purchase agreement still has to be accounted for with all those items I talked about, but it's a much more streamlined process. But what are the downfalls of the stock purchase agreement? The downfalls is that you acquire everything you acquire everything, the good and the bad. So if there's a pending litigation, or if there's a pending liability issue, if it's being investigated by the OIG, you acquire that as well, unless you specifically draft a very specific provision that says the outgoing seller is going to make you whole for any amounts that is incurred for whatever that liability is. There's ways around it, but you just have to be a lot more careful with the stock purchase agreement, and the amount of time you use to do your due diligence, I think, has to be ramped up a lot more. Of course, a merger is really when two companies come together. There's always going to be one that survives, and the other one that doesn't survive. You won't see that name, and that kind of goes away. So it's when two companies come together and the target goes away, and essentially the buying entity, or the one that's going to take over the company, that one is the surviving company. Next. So the asset purchase, it's when the buyer acquires all or some of its assets. What are your assets? Your intellectual property, your ARs is huge. Your license. Probably the two biggest ones is your license and your Medicare certification, or the payer sources. Those are all assets. Your ARs and any tangible items. You're not buying the company. Typically, you're a company is coming in and acquiring all the items that you want from the selling company. There's a very good place and time for an asset purchase, and it avoids successor liability, like I talked about before. It's a lot more labor intensive because you do have to do a change of ownership, both at the Medicare level and at the state level, typically, because there is a change in tax ID number. And of course, with the A50 filing the A55, there is a CHOW on the Medicare level. You get to pick and choose what you want to buy. So the pricing can adjust too based on what you buy, and also you avoid successor liability. That's the big one, but it is a lot more labor intensive to draft asset purchase agreements. And I'm sorry. Okay. However, there has been occasions, depending on the situation, that subsequent buyers have been held liable for asset purchases as well, and it's very fact specific. But just know that with the asset purchase, you're going to be able to pick what you buy and what you don't want to buy, and if the if the selling entity has a bad local reputation, that's something that you should consider instead of going in and buying the agency itself. And think about the employees. If you have a marketer that that for some reason the marketer doesn't want to work for the former entity and they just want a brand new start, whether it's psychological or emotional, maybe, and that marketer has all the referral sources or has all the relationship for referrals, that may be something to be considered, is that you buy the agency and its assets and you form a new company, giving that key marketer essentially a psychological restart of a new career with a new company, and they bring along with all the relationships as well. Of course, a joint venture is when two companies come together for a common purpose, and there's no merger. You can go into a joint venture saying we're going to go and try to do whatever your objective is. I just wanted you to be aware what the difference between a joint venture and a merger. There's no acquiring anybody. You're not part of the same company. It's essentially two people coming together. Now, granted, you can actually form a new company and actually have the two companies come together to form that new company. That's technically a joint venture as well. But I just wanted you to know the difference. Next. So from a Medicare and Medicaid side, of course, I already told you what the change of ownership is. Sometimes it can be very time intensive. It takes sometimes 90 to 120 days following a closing to complete the Medicare CHOW. You'll get a notice, what's called the tie-in notice. It's essentially letting you know that the incoming buyer is their bank account, or the money is really tying to the new buyers now instead of the former buyer or the former operator, that is. Usually the MACs are involved in handling the change of ownership. Of course, Medicaid contracts is handled by TMHP and HHSC. When you do the change of ownership, filling out the 855, that does not cover the Medicaid contracts, so just know that. Just be aware that CHOWs impact cash flow. So you have to understand that Medicare and Medicaid agreements, what it says, and be ready to just be aware that after the sale, the money could still continue to go into the seller's accounts, even though the incoming buyer is operating the agency. So you're going to have to come to an agreement with the seller on how to handle that. Next. CMS maintains oversight compliance for Medicare health and safety standards. Just giving you an idea of what CMS does. Again, I know a lot of you are very seasoned in this industry. There are probably some people on this call who are very new. The survey for this determination is done on behalf of CMS. So in Texas, the state actually does it on behalf of CMS. And of course, CMS has published, they publish a mission and priority document outlining guidance for home healthcare agencies applying for initial certification. Next. These are some buyer and seller tips. Really, it's really two parties coming together that has an idea of what they want to achieve, and they have to really work together, and they have to have it's helpful to have a healthy line of communication of what the expectations are. One thing I've noticed is that if you don't communicate expectations as far as timing is concerned, and who is taking on certain tasks, that can really kind of impact the deal. So from the side of a seller, you're going to want to require the buyer to file its CHOW application by whatever specified timeline that the acquisition is to be completed. So holding the buyer to file its application and to be diligent with the information it discloses, because if the buyer sends in information and fails to fill out all the blanks, or fails to provide all the necessary information to the state, then that's going to hold it up. The seller should dictate on timing, on notices to the state agent, and they should require status updates on the chow. On the part of the buyer, you should set realistic expectations on. Beyond this, you should really set expectations on what the due diligence time period looks like, and of course, the key is to hold the seller to disclose due diligence information within a timely period. If they get delayed, then it holds up the deal. And people always ask me, well, how long does it take, or how much is it going to cost? Well, it depends on the working relationship between the buyer and the seller, because if the seller is delaying it and I have to reach out to the seller a lot, then that's going to increase the legal spending as well. So that's one of the reasons. I mean, that's just one factor on why it's sometimes hard to predict or even control how much you spend on the sale. So just keep these things in mind. These are just some very general tips. There's a lot of other stuff. Of course, given the time, I can't go over everything. Next, I think that's the last slide though.
Okay, well, everyone, we do have a few questions that we want to touch on and answer those before we do finish, even though we're right at our time. We wanted to let you know we have our contact information on this slide that you're seeing now for our different websites, as well as how to contact us directly if you have questions. And we just want to say thank you so much for coming to today, as well as any other events that you've done in our series. As we mentioned at the beginning, the recordings as well as the presentation slides are going to be at the website link that you see listed there, and they will remain up there indefinitely. If you have any questions about the website or any of the materials, please feel free to give us a call at the number that's listed here, or you can email the info@hc-link.com address. And like I said, they'll remain active until further notice. Amy hosts the recordings actually on her YouTube channel, and she has some other opportunities for information available on that YouTube channel also. So I would say check those out, and that way you can get some additional information that may not be specific to the pandemic recovery. So Amy, why don't we pull up the questions that we do have and see what they are and who might need to answer them?
Let me answer the second one real quick, because it's asking about the PPP slides from that bonus session we did. I will say there was a little mix-up in the post-webinar email. We were physically editing it when Zoom sent it out. So it had like the link to the recording and not the slides, and it was a mess. It is on the website. They are on the website now. I just went there. I just downloaded them. So it's on that hc-link.com. And then right there, it's got more information about the pandemic, and they're all on that website. So you should be able to find those there now. The other one, I think is for Richard. It says, can you give us an idea about the average dollar value of acquisition in the last 6 months?
The average, I would have to, I've done some that's over 10 million, and some that's 250,000. So, and everything in between. It depends on who the buyer and who the seller is, and sometimes it's a roll up of multiple sites. So if you have more sites and you're generating more revenue, and that your EBITDA is healthy and there's very limited exposures, then instead of a 4 to 5 turn EBITDA or multiple EBITDA, you could even get maybe even a 6 or 7, depending on who you are. Very rarely do I see that, but on average, I see between like a 2 and a 4.
Okay, and the next one is it possible to buy a state-run home health agency, as in a home health that's part of a local health department? I think you can, right? Because, you can have a hospital-based home health agency, and it might be a county hospital.
Yeah, absolutely. I mean, you can buy it. You just have to, the process is going to be different, but you can buy it. Yeah. Yeah.
I had a independent freestanding home care sale to a hospice group. That was a county run hospice. That was the other direction, but I did see that. Are there more institutional buyers or existing owners?
I would say there's more existing owners, but I would say the dollars by institutional buyers are significantly more.
Okay. And then lastly, it just says, awesome information, thanks. Anybody got anything else that we can answer? I don't think there's anything in chat. The slides, again, the slides and the presentation, you will be redirected to the website at the close of the session. You'll be redirected to the website. Tomorrow, you'll get an email instructing you that the recording and the slides are live on the website. So that'll all be up by tomorrow. And there's another question. Is there is there I don't know what the question is. Is there?
I think, Amy, this is Charity. I think they're asking, is there such a thing as an as-is sale possible as far as without the escrow? You know, is there such a thing as, you know, executing a transaction where you buy it as it is, you take everything as it is, and Richard, that was the question that was posed, and I think they mean as is on that one.
Is there an as is? Oh, okay. You could, I mean, yeah, you could have that. It depends on the deal, depends on the buyer, it depends on what your agency looks like, and what, you have to think of it as when you're selling agents, you're really selling a product, right? And if the product has wrinkles in it, then it has wrinkles in it, and it needs to be addressed. If it doesn't have wrinkles, the seller is going to have a lot more leverage and a lot more selling power.
And that was it. That's all one question. Let me make sure. There might be one more at the bottom. I think he just said thanks. So I think that's all we got, guys. Good information.
Okay. Thanks, everyone. Have a great rest of the week. And appreciate you coming.
Thank you, guys.
See you. Bye-bye.
Bye.